Hi there, I'm Champion Trader Kevin Davey, and today we're going to build a simple algo for crude oil. So let's get started. Okay, so today I'm going to build a simple algo for crude oil. And you may or may not want to trade this yourself based on what you see, but the important point is I want to show you how you can develop your own algos. And so then you can go off and develop algos for any market that you want. Now, unfortunately, the way most people build algos is they create a great back test, like the chart on the left, and then they go live and it falls apart, kind of like the chart in the middle, and then they start pulling their hair out like this guy does. So that's how most people develop systems. They just do things the wrong way. They create a great back test, and then as soon as it goes live, it falls apart. It used to happen all the time to me. It doesn't so much anymore. But every once in a while, one of these guys sneaks in there. But I have things in place to keep them away. But the point is, this is how most people develop systems. They do things the wrong way. So today, I'm going to give you some steps that will help improve what you're doing if you fall into this trap. So first, we start out with entries, right? So you come up with an idea. You don't know if it's going to work. Obviously, you're going to test it, but it's important to come up with an idea. Maybe you find one on the internet. Maybe you think one in your head. Maybe you get one from looking at charts. It doesn't matter. You can find one just about anywhere. And this one, what we're going to do is we're going to buy pullbacks in trends or sell short bear pullbacks. So what we're going to do here is trade pullbacks in trends. So for example, if you're in a downward trend and it pulls back up, maybe that's a good time to go short. Or in an uptrend, when it pulls back, maybe that's a good time to go long. So that's a pretty standard thing. A lot of people do this type of trading, but we're going to see how well it works. Now, the problem is, how do you define all this, right? I just showed you some lines and said, oh yeah, sell here, buy here. Well, when you're algo trading, you've got to define it. You can't just eyeball it and say, oh, this looks like a good point to buy or a good point to sell short. So you have to first define a trend. We're going to use simple momentum. If the close is greater than the close so many bars ago, that's it. And then a pullback will be a shorter term momentum. And if that momentum's down, so let's say we want a long trade, long momentum's up, but then the short-term momentum's down, that'll be the time to buy. And obviously, that's just one possible way to do it. There are a ton of different ways to both define trends, define pullbacks, and when to take the trade. So we're just going to do it this way. Now, for a market, I picked crude oil. Crude oil is a good market. It has reasonable slippage, has lots of volatility. It has some nice trends. It's a pretty good market. And if you want to trade smaller size contracts of crude oil, those are available too. So this is a pretty good market. Then we have to ask ourselves, what size bar? Well, if you picked up my book, Algo Trading Cheat Codes, you'll know I did a study of 40 different futures markets and looked at different bar sizes. And I kind of determined what bar size is the best. And basically, for many markets, daily bars or 1440 minute bars, which are 24-hour bars, they're usually the best as far as profit goes. When you start getting to real small bar sizes, the trading costs kind of eat you alive. So a lot of times it's good to go with longer term bars, and then you don't make as many trades and your trading costs go down. So for this algo, we're going to use daily bars. And we're going to use a simple stop and a simple profit target. And you've probably heard, hey, the reward to risk should be 3 to 1, should be 5 to 1, should be 1 to 1. Whatever you've heard, in this cheat code book, which you can get, I also did a study on that. So for crude oil, we're going to use 1.5. So meaning we're going to go for losses, let's say, of $500, and then our wins would have to be $750. So 1.5 times the losses, that'll be your wins. And that's based on a lot of data that I've analyzed. So we code it up. This is what it looks like in TradeStation. Easy language is what they call it. And it's pretty easy. You could pretty much read this. If the close is greater than the close of days back, which is a number, and the close is less than the close of days back divided by 4, which is a shorter term momentum, then you buy. The opposite happens, sell short. You put a stop loss and a profit target there, and that's it. And you might say, wow, that's too simple. You can't make an algo that simple. Well, what I've seen is when you have simple systems, your back test is going to be worse, but your real-time performance will probably be better. You can have a perfect looking back test, but my guess is it'll probably fall apart because there'll be too many rules and it'll be over optimized. So simple tends to work the best going forward. And I would bet 80 to 90% of algo traders out there don't get that, or at least don't fully embrace it and understand it. They still try to make the best back test they can, and that's a mistake. So we code it up. We do a little test. I like to do a 2-year test just to see if it looks good. And this does over a wide range of variables. You want to see if the strategy's robust. That's what I do here. So I change stop levels. I change momentum values. And you know what? I almost always make money with this strategy. And that to me is a key sign that it's a good strategy. Next, I go into what I call walk forward testing. This is my big test. And I don't have time to explain it all and do it all for you here. So in this video, I'm just going to use out of sample testing, which is not quite as good as walk forward, but it's still pretty good. So what I'll do is I'll optimize from 2007 to 2017. That'll be my in sample period. And then I'll get the best set of parameters and I'll apply it to 2018 to the present day. And that'll be my out of sample. And we'll see how that works. So here's the in-depth testing. Here are the results. Now, this looks okay. This isn't the best looking equity curve by far. There's a lot of significant drawdowns here. And this is all trading one contract after including costs. But over time, it makes money. Early on, the first 50 or so trades, it made a lot more money. But it's still been going up and to the right. And that's what you like to see. And you might say, hey, I want something that looks a lot better. Well, you can do it. But the problem is, it might not work going forward. Remember that. It's not about building a great looking back test. It's about building a back test that will tend to work going forward. And again, those are the simpler strategies. And it's a paradox. I understand that. Just because you have a great back test doesn't mean it's going to work going forward. And most people don't get it. So let's look at the out of sample the last 3 years. And that's the green highlighted area here. It looks pretty good. So it's still making new highs and it's still making money. There's drawdowns for sure. This isn't a strategy that would necessarily be very easy to trade, but it does make money and it does head upward. So in that respect, it's good. Now, there's a couple other steps just in the interest of time that I did not cover here. I usually run Monte Carlo analysis to help me to see if this is a good return to drawdown strategy, if it's the ratio of those two, which is a risk-adjusted return, if that's good. I also do something called incubation, which is watching the strategy live for a period. And students who've taken my workshop, 90% of them say that step alone saves them money. So it's huge. Don't underestimate just watching a strategy live for a while. And then the other thing I didn't talk about was diversification or position sizing. This strategy, trading it alone would be kind of tough during those drawdown periods. But maybe if you had other markets that you were trading, you're trading the euro and coffee and soybeans and wheat. If you had other markets and other strategies, they might all work together really well. And that's as close to the holy grail as you can get with algo trading. It's diversification. You could trade a bunch of different systems, a bunch of different markets, and you could become diversified and get a smoother equity curve. So that's something else I didn't talk about in this video. All the steps I used are listed right here. I use an approach that I call the strategy factory. It's a trademarked approach with the US government, and I only went through some of the steps today, but these are the steps you can use, and when you do things correctly, you could create systems that tend to work in real time. It's not a guarantee by any means, but when you follow the process I use, you're more likely to have good strategies. Of course, I've left out a lot of details. I didn't tell you what is good and what is not good, and what's the right way to test, and how don't you over optimize, and those kind of things. But this should at least get you started to understand that, hey, I don't need a perfect back test. 2, I should look for robustness in my trading. And 3, I have to have a rigid process that I treat all strategies the same. If you do those 3 things, you'll be well on your way to creating some profitable algos. Well, I hope you enjoyed this video. If you did, please subscribe to my channel. I'll keep creating more. Please give it a thumbs up and leave a comment. Let me know what you do. Do you do something different? I'd love to hear it. Thanks for watching. I'm Champion Trader Kevin Davey, and happy trading.